Well, good morning, everyone, and welcome to the fifth installment of our quarterly compliance webinar series. We're delighted that you chose to spend part of your morning with us. For those of you who don't know me, my name is Brad Stumpy. I'm a partner and the practice leader for financial institution compliance and loan review services at Anders. I'll be joined on this stormy, but at least cooler, St. Louis morning by the usual suspects, Sadie Carrera, Sandra Lane, and Jessica Likey, all of whom are former bankers, specialize in loan compliance, and have a decade or more of experience in the industry. And many of us wish we could just say that it was 1 decade. Before we get too far into this, I want to point out that if you'd like to download the materials, there's a link to the slides in the chat. We'll also send them out with the recording, but if you want them sooner, so now, head on over to the chat and you can grab them. Sandy and Jess are in the Q&A, so please submit your questions through the Q&A feature and not through the chat as we move through the session. What we don't get to during the presentation, we'll do our best to answer in the post-webinar materials. So let's go ahead and advance the slides and get this thing started. So while most of our webinars cover a new rule like 1071 or CRA modernization, this one will focus on common errors we see in a couple of areas with established rules: adverse action notices and mortgage servicing. While the mortgage servicing rules still feel new to me, the bulk of what we have today was issued over 10 years ago, back in 2013, as a result of the Dodd-Frank Act. And of course, they've been amended and added to over the years since. Looking into the future, my guess is that most, if not all of you, are aware that loan servicing seems to be the next area of emphasis in the CFPB's campaign against fees. And we could probably use a little more aggressive language than that. They surely do. So be sure to keep your eyes open for what's next on that front. I'll kick things off by covering some of the common errors we see with adverse action notices, and then I'll hand it off to Sadie to discuss common errors we see in loan servicing. I'll then rejoin towards the end to briefly touch on the CFPB's recent supervisory highlights that focused on loan servicing, and also to wrap things up. As we work our way through the material, please keep in mind that this will not be a comprehensive review of adverse action or servicing requirements. We'd be here for much more than an hour. This will simply be a high-level overview of common issues we see in these areas when performing loan compliance procedures for our clients. All right, so let's jump into adverse action notices with one more reminder that Sandy and Jess are monitoring your questions in the Q&A feature. So if you have any questions, please place them in the Q&A feature and not in the chat. Two primary regulations govern adverse action notices for credit requests. The first is Regulation B, which implements the Equal Credit Opportunity Act, or ECOA. Section 1002.9 is where you'll find most of the requirements surrounding these adverse action notices, although you'll need to chase down some loose ends in other sections, just like with any other reg. The second is Regulation V, if we could go ahead and advance the slide, which implements the Fair Credit Reporting Act, or FCRA. The elements of the Fair Credit Reporting Act that address adverse action notices have not been incorporated into Reg V. So in reality, you need to look to Section 615 of the Act as your primary source for those requirements. These two rules are not consistent on who should receive an adverse action notice, which causes our first common adverse action error: the co-applicant not receiving the AAN when they should. A Reg B requires notice to only the primary applicant. So generally, this will be the first applicant listed on the application when there's more than one. FCRA says that the notice must be provided to any consumer against whom adverse action is taken based on information in their consumer report. So there's no multiple applicant provision in the Fair Credit Reporting Act. From time to time, we see this difference come into play when information from the co-applicant's consumer report contributes to the decision to deny the request, but the adverse action notice is provided only to the primary applicant as required under Reg B, and thus does not comply with the FCRA rule to provide the notice to any consumer against whom adverse action is taken based on information from their consumer report. So that'd be the co-applicant not receiving the notice when they should have in this scenario. Just be aware that there are situations like this when adverse action notices must be provided to both the applicant and to the co-applicant, even though Reg B says that providing the notice only to the primary applicant is sufficient. The next common error we see is an untimely notice. And it often comes down to, when does that 30-day clock start ticking? It starts ticking when you receive a completed application. And the rules do not specify what it takes to have a completed application. That's up to you. For smaller community banks and credit unions, we often don't see a policy or procedure that defines a completed application. For larger institutions, a completed application may be defined, but staff are often not familiar with what that definition is, and the concept is inconsistently applied. So if you're taking notes now, Brad said to think about defining what we consider to be a completed application. Keep in mind that this will be different for a home loan versus a car loan versus an unsecured loan versus a business loan, and so on. Another important component to that procedure, so write this down also, will be how you document the exact date that you have a complete application, so we know when that clock starts to tick. When the home loan market was hot a few years ago, waiting times for appraisals were long. We'd often get the explanation that the denial came out more than 30 days after the date on the application because you're waiting on an appraisal. And that makes sense if you ordered the appraisal in a timely manner and it simply took a long time to receive due to the appraiser's backlog. If you didn't order the appraisal until, say, day 25, because of your internal backlog or for whatever reason, that makes less sense. Reg B states that the creditor, so you, must exercise reasonable diligence in obtaining the information. That also makes sense if you can show that the denial went out within 30 days of the time you received the appraisal. You don't get an unlimited extension, and you can also show that the reason for denial related to the appraisal. It makes less sense if the applicant was denied for something else, let's say delinquent obligations with others. There could be that unique situation where the applicant's credit history was borderline, could have been salvaged by a strong LTV, but the appraisal came back showing a borderline to poor LTV, so the combination of the two resulted in a denial. It makes sense then that you waited until you received the appraisal. However, if the credit history was so poor that it didn't matter what the LTV was, you weren't going to make that loan, then it's going to be more difficult to support that it was okay to hold the adverse action notice for more than 30 days while you waited on an appraisal that didn't really matter. In that instance, someone may even question why you bothered ordering an appraisal in the first place. There are also times when we ask about why there were more than 30 days from application to adverse action, and we'll be told that it was because the applicant hadn't provided everything you requested, so it was not yet a completed application. And that brings us to the issue of incomplete applications. Now, there's a difference between waiting on information from someone other than the applicant, like an appraiser, and waiting on information from the applicant. So when you're waiting on information from the applicant, there are two options when you hit the 30-day mark. The first is to send an adverse action notice for an incomplete application. So a normal adverse action notice that says, hey, Brad, we are denying this request because of an incomplete application. If you do that, it closes the file, just like denying the application for a poor credit history or low loan to value. The second option is a notice of incompleteness, which keeps the credit request open beyond the 30 days. Notice that there's not an option number 3 that says do nothing and continue to wait for the applicant to provide the data. So if you choose the notice of incompleteness under option 2, that notice, like an adverse action notice, must be in writing and must include certain required elements. You can look to sample form C as in Charlie 6 in Appendix C of Regulation B for an example, and we have those elements listed on the next slide. So first, the notice must include a list of the specific information that is needed. Second, the notice must include a reasonable period of time for the applicant to provide the missing information. And there's no guidance as to what's considered reasonable, but 30 days usually seems to be safe. And then third, the notice must include a statement that failure to provide the requested information will result in no further consideration being given to the application. So something to the effect of, hey, Brad, we need your 22 and 23 tax returns and your most recent pay stub by July 15th, or we'll consider the file closed. After you send this notice, if the applicant does not provide the requested information by the specified time, you have no further obligations. You do not then need to send a notice of adverse action. If they do provide the requested information by the specified time, then you have a completed application on the date that they provide the final piece of information that you're going to, of course, document well, so you know when the 30-day clock starts to tick. And then you have those 30 days to notify them of the action taken. All right, so I think that covers incomplete applications. The next problem area that I'd like to discuss is counteroffers. So if you weren't all muted, I'd bet a nickel that we'd have heard a collective groan when I said counteroffers. For those of you that have been with us in the past, you know that we like to throw in a couple of polls along the way, and we'd very much appreciate your participation. So to show you just how much we appreciate your participation, with each poll, we'll select a winner from among those who participate to win a Starbucks gift card. So good luck. All right, so our first poll question is, how do you classify an unaccepted counteroffer? So choose from approved, not accepted, withdrawn, denied, or maybe option D, confused. So at this point, it looks like most of you, it's 80% have denied, 16% approved, not accepted. It's moving back and forth a little bit, 6% withdrawn. So we're settling on about 76% denied, and that's the correct answer. So option C, denied, is correct here. I asked for a $100,000 loan, and while you approved a loan for $75,000, that's not what I wanted, and I didn't accept it. So you, in essence, denied my $100,000 request, and all of the rules then surrounding a denied application are in place. So hopefully that makes sense to everyone. All right, just as with incomplete applications, there's two options with counteroffers. From an administrative standpoint, option number one, I think sending a combined counteroffer and adverse action notice is probably the easiest. Hey, Brad, we can't provide you with the loan you requested because the appraisal came in too low, but instead of the $100,000 loan you wanted, we can lend you $75,000. So if you choose option number one, there's nothing more to do if the applicant does not accept the counteroffer. That being said, not everyone likes this option. They don't want to officially say that we're denying the original request when they're still trying to salvage a deal, and that makes sense. So if that's the case, then you can use option number two, which is making the counteroffer. And if I accept that $75,000 loan, there's nothing more for you to do other than close the loan, and you don't ever have to officially say that you denied my original request. However, if you selected option number two, and I do not accept the $75,000 counteroffer, then you need to send me a normal adverse action notice within 90 days of making the counteroffer. So you've got one more thing to track and potentially act on. If you choose option one, you want to take a look at model form C4 also from Appendix C to Regulation B. And we've got more information regarding that on the following slide. So the notice will need to include everything on a normal denial, including the reason or reasons that you cannot originate a loan on the originally requested terms, along with the date by which the counteroffer must be accepted, and that doesn't have to be 90 days, and then how the applicant can accept the counteroffer. Again, if you choose this option and the applicant does not respond within the specified time frame, you have no further obligations. So let's continue to our next common error, and that's the reason for denial. The whole point of the adverse action notice is to let the applicant know why they were denied, where the information came from, and who the applicant can contact if they think the information is incorrect or that they've been discriminated against. So it's of utmost importance that the reason for denial is accurate. Adding to that importance of the denied applicant having accurate and complete information, if you're a HMDA reporter who reports the reason for denial on your LAR, anyone performing a fair lending analysis, especially an underwriting analysis based on HMDA data, is probably taking that reason into account. As we're reviewing adverse action notices, errors with the reason for denial can take on one of several forms. So first, be sure that the reason or reasons on the adverse action notice match the file. This can be a complete mismatch, but more often is an incomplete list where the AAN includes one or two reasons, when notes in the file indicate additional reasons for denial that were not disclosed. The applicant can't fix a problem that they don't know about. At the other end of the spectrum are the applicants who have more working against them than they do working for them. While you want to let the applicant know what needs to be fixed, the commentary to Reg B states that more than 4 reasons is not likely to be helpful to the applicant. So pick at most the 4 primary reasons. If there are only 1, 2, or 3, that's fine, and it's correct to only list the 1, 2, or 3 reasons. Unlike with credit score information that we'll get to in a couple of slides, there's no requirement that you must list 4 reasons for adverse action. The third mistake we commonly see in this area has to do with applications for unsecured credit. The reason for denial should not be lack of collateral. They applied for a loan with no collateral. The reason for denial should be why they don't qualify for unsecured credit. Is it insufficient income, delinquent obligations, something else? You can make a counteroffer and say, hey, Brad, we are willing to make you a loan with acceptable collateral, but here's why you didn't qualify for unsecured credit. And the final item on this slide also goes back to the concept of the applicant being able to fix the problem. If the reason on the AAN is simply credit score, the applicant doesn't know what they need to go fix. More specific and actionable reasons should be disclosed. Before we move on from this slide, I also want to mention use of the other box. Consider having some type of guidelines, parameters, approval process, whatever works for you, to be sure that anything in this field is acceptable. We see some creative uses of this box that you might not want an examiner or an opposing attorney to see. One of the more interesting ones that I recall is the other box was checked and the free-form text had not 21. So what's that rule about not discriminating based on race, color, religion, sex? Doesn't age fit in there somewhere? So while there are lots of things you probably don't want to see in this field, one that could be considered overt discrimination probably tops the list. Now, the response I received when I brought this to management's attention was, yeah, he was probably just remembering too far back. Like 50 years ago, too far back. All right, so on this slide, when we reference CRA, it is not the Community Reinvestment Act CRA that's made all the headlines recently, but rather refers to consumer reporting agencies. As we discussed earlier, there's a difference in who should receive an adverse action notice under ECOA and under FCRA. While there's some differences, these two rules work together when considering the content of AANs. Some of the information on a typical adverse action notice is required by ECOA, and some is required by FCRA. The CRA information is required by the Fair Credit Reporting Act. On many adverse action notices, there are two places where CRAs are referenced. The first is when information from a consumer reporting agency was used, in whole or in part, in making the decision to deny the credit request. On most AANs that we see, this is located just below the list of specific reasons for taking adverse action. And the primary exceptions we see with this are listing the original source of the consumer report, so usually one or more of the big three, rather than an aggregator or third party when such a provider was used. And the second common exception we see with this information is that contact information, address, telephone number, has not been updated. That's easy stuff to put on your calendar to check every so often. The second reference to a consumer reporting agency on most adverse action notices is regarding the credit score information. And this should be who created the credit score that was used. So if you obtained the consumer report from an aggregator, that's the CRA that should be listed first, and then used a credit score from one of the big three, that one of the big three is who should be listed as providing the credit score. Another common error we see with credit score information has to do with the 4 factors that most adversely impacted the credit score, even if it was a good credit score. So this can be 5 reasons if the number of recent inquiries is one of those. And we often see the number of recent inquiries excluded as the 5th reason. So just as we mentioned, ensuring that you're using current and accurate contact information for your consumer reporting agencies, do the same for the federal agency that has primary enforcement authority with respect to Reg B for your institution. So while not real recent, the FDIC information is the most recent to be updated, and we're still seeing adverse action notices with outdated information for them. So if you're a state chartered non-member bank, the FDIC is the contact information you'll want. Depending on how you're chartered, your total assets, this could be the Federal Reserve, the NCUA, the OCC, the CFPB, maybe the FTC, and several other agencies who I don't think we have represented in today's audience. And we often see problems with this after mergers and acquisitions, after a new system has been implemented, after a current system has been updated. So that's a good time to check. And then just put it on the calendar, once a year to check and be sure it's the correct agency and has the current contact information. So this agency information, it's in the section that essentially says, Reg B prohibits us from discriminating against you on the basis of race, color, religion, national origin, sex, and so on. I'm not going to try to name them all because if I do, sure enough, I'll leave one out. But I promise you that I wouldn't remember too far back and forget about age. So anyway, that non-discrimination paragraph is what we often see left out of letters that creditors sometimes craft themselves as a kinder or substitute adverse action notice for commercial applicants. And AANs for business applicants is the last thing I want to touch on, before handing the baton to Sadie. So with the Olympics coming up, maybe you caught that Olympic reference, go USA. All right, commercial denials. The demarcation line has long been gross annual revenues of $1 million. This is one of those numbers that we're glad they haven't indexed to inflation or otherwise periodically increased. It keeps the threshold relatively low. So if GAR or $1 million or less, you essentially need to treat this as a consumer deal. Reg B does say that the statement of action taken, hey, Brad, we're not going to be able to make the loan for your dog grooming business, may be given orally or in writing. If you're going to allow for oral notification, be sure that you're documenting when and with whom that conversation took place, as you're still subject to the timing and record retention rules. For the small businesses, At the time of application, you can also provide a statement informing them that they may request a statement of specific reasons should the request be denied, and that you cannot discriminate against them. And here's the federal agency to contact if they think that you do. So if you choose to take this route, be sure the notice is in a form the applicant can keep. And the in a form the applicant can keep rule wasn't always there. And we would see this on the bottom of financial statement forms. That's no longer good enough. It's got to be something you reasonably expect they're going to keep. Bottom line is we see most clients treating business credit denials for businesses with revenues of 1 million or less the same as consumer denials, because when they've tried to do otherwise, it's just become too difficult to manage. So for businesses with gross annual revenues of 1 million or more, it's pretty much just a matter of documenting when you notified whom to show that it's reasonable. Probably the biggest thing that comes to my mind when we talk about commercial denials is the lack of them. It's not uncommon to go into a decent sized shop, ask for the commercial denials for the past year, and get a thin little file of 3. Really? You originated all but 3 requests for commercial loans during the past year? I think just increasing our commercial lenders' awareness of these requirements will be a step in the right direction, especially as we approach 1071 implementation, when we must have reasonable procedures in place to request all of that information early in the process. I think we're going to see an increase in the number of non-originated commercial apps. And that brings us to our next poll. And realizing that legal challenges to 1071 remain, while acknowledging that particularly for Tier 1 reporters, we probably can't put off preparations much longer, how are you handling commercial loan applications? And remember, if you participate, you've got a second chance for a Starbucks gift card. Have you A, historically had a commercial loan app? B, recently developed a commercial loan app? C, are you planning to develop a commercial loan app? Or D, are you going to try to find a way to comply with 1071 without resorting to a commercial app? And at this point, it looks like most of you, which kind of surprises me, 43% it says historically had a commercial app, 34% are planning to develop one, 11% recently developed, and 10% you're going to find a way to comply without resorting to commercial app. I think that's going to be difficult, but man, that'd be wonderful if we could come up with that. And if you do, I would love to hear about it. So I'd like to thank you very much for your attention and for your participation. I'll now hand things over or pass the baton to Sadie for a discussion on mortgage loan servicing.
Excellent. Thank you, Brad. Good morning, everyone. I'm Sadie Carrera, a compliance manager with Anders CPAs and Advisors. Brad just finished covering the tricky aspects of adverse action. And now we're going to move on to loan servicing. And then I'll pass the floor back to Brad for some supervisory highlights and closing remarks. There are a lot of information within the loan servicing rules, and we will not get to cover everything today in our hour. However, I've pulled out some of the most relevant information and most common errors that we see during our reviews and the agencies have noted as of late. So let's first start with the regulations. Today, we're going to cover some of the aspects under Truth in Lending Act, or TILA, the Real Estate Settlement Procedures Act, or RESPA, and the Flood Disaster Protection Act. So under TILA, we'll cover ARM, interest rate, and payment change notices, prompt crediting of mortgage payments, escrow account cancellation notices, billing error resolution, and mortgage periodic statements, as you can see, is a large servicer requirement. Now, under RESPA, this slide includes some aspects we will cover under RESPA. And you can see the first 4 are solely large servicer requirements. So general servicing policies and procedures, we have early intervention, continuity of contact, loss mitigation, some force place hazard insurance, annual escrow account disclosure statements, and qualified written requests. And then under the flood rule, we're going to cover new force-placed flood insurance policies and renewal force-placed insurance policies, and also force-placed flood notifications and timing. So in the next few slides, we will discuss some of the large servicer requirements. But first, we have a short interactive poll. Is your institution considered a large servicer? So for A, we have yes, we are a large servicer. No, or B is no way, we're a small servicer. And C is I have no idea, how would I know? And if we just scroll here, let's see what we have. The results, as I thought, we have 56% as no way, we are a small servicer, and that seems to keep growing. We have just a very few, maybe 25% are a large servicer. And we had a few that say, I have no idea, how would I know? So thank you for participating. So for those of you that have no idea, how would I know? Let's talk about when does an institution become a large servicer? What actually triggers that change from small servicer to large servicer? So as you can see, first of all, we have a volume threshold. A large servicer will service more than 5,000 closed-end mortgage loans. This includes when a servicer is the originator or assignee, and it includes affiliates. It also, when you service any mortgage loans for others, when you receive compensation, and that's without regard to a volume of how many loans are serviced. So just as an example here, if you service 3,000 closed-end mortgage loans that you have originated, and then you service 200 closed-end mortgage loans for another lender for which you will receive compensation, you still qualify as a large servicer. Also, as you can see by this slide, a nonprofit under Section 501c3 of the Internal Revenue Code is also a large servicer if they service more than 5,000 mortgage loans. And again, that includes the servicing that you originate and you assign, and also includes affiliates. Now, these thresholds are evaluated based on the mortgage loan serviced as of January 1st and for the remainder of the calendar year. And finally, you may be a large servicer if you meet these threshold requirements and you are not a housing finance agency as defined by 24 CFR 266.5. So just for example, one that most people on this webinar will know, the Missouri Housing Development Commission, or MHDC, is a Missouri housing finance agency. Now, what types of loans are we talking about when we're determining this threshold? Well, we're talking about closed-end consumer credit transactions secured by a dwelling, regardless of lien status. So those closed-end seconds would also be considered in this determining the threshold. The slide also lists some loans that are not included in the threshold. Loans that are voluntarily serviced for a servicer or non-affiliate in which no compensation is received. Not sure how many of us would do that, but also reverse mortgages, some loans secured by timeshares, and transactions serviced by a seller financer, meeting the criteria under 102636A5. Now, the next slide just lists some aspects of large servicer requirements: written policies and procedures, mortgage periodic statements, we have early intervention, continuity of contact, loss mitigation, and, which is a surprise to some of us, prohibited force-placed insurance in certain instances. On the next slide, we'll talk about what's important to note about written policies and procedures is just that the rule requires large servicers to author written policies and procedures. And these policies and procedures have required objectives and standard requirements. Those are detailed in section 102438. Now, while we do not have time today to cover all of the required components and standards, Here are some of the more frequently omitted components and standards that we identified during our reviews. One of which is promptly facilitating communication with potential and confirmed successors in interest, and confirming a successor in interest's identity and ownership interest. Also, record retention requirements for mortgage loan accounts of 1 year after discharge or servicing transfer, and the servicing file creation and maintenance needs to be in a manner which facilitates compiling data within 5 days of the request. So these timing requirements are most often forgotten. The second aspect that is required for large servicers are mortgage periodic statements. These statements have certain content and format requirements that can be found in the section or model form noted on the slide. Now, there are certain instances in which a coupon book can be provided in lieu of a periodic statement, such as for a fixed rate loan, but that coupon book must also include all this required content. And a mortgage periodic statement is not required at all in certain instances, such as upon servicing transfer, the loan gets paid in full, or it's discharged in foreclosure, among others. Some of the most common errors we see with the provision of the periodic statements are the fact that the periodic statement must be provided within 4 days of the close of the courtesy period of the previous billing cycle. So this means if your note has a 15-day grace period until the payment's considered late, with the imposition of a late fee, the periodic statement must be provided within 4 days of the close of that 15-day grace period. Another common error is that a modified statement is not always being provided as required in certain specific circumstances, such as for delinquent borrowers or borrowers in bankruptcy. The next large servicer aspect is early intervention. The large servicer must establish or make good faith efforts to establish live contact with borrowers by the 36th day of delinquency. And again, after each payment is due, just as long as the borrower remains delinquent. Now, we will discuss establishing live contact and making good faith efforts to establish live contact more on the next slide. Also, under early intervention rules, a servicer must provide borrowers with a written notice that encourages them to contact the servicer. And if appropriate, the servicer must promptly inform the borrower of any loss mitigation options that may be available to them. Most of the errors made with early intervention will involve establishing live contact. Establishing live contact includes telephoning someone, getting them on the phone and talking with them, but not leaving a recorded message, or conducting an in-person meeting with the borrower, not just sending notifications. As we all know, there's many times that we just cannot reach a borrower. We could call 100 times, no matter how many notifications and letter we send them, they just don't call us back. So in these instances, the rules allow for the servicer to make what is referred to as good faith efforts to establish live contact. So what does this mean? Well, good faith efforts in establishing live contact means making reasonable steps to reach the borrower, so that one phone call may not be enough. You may have to call on several occasions, or more than one occasion may be necessary. Also, when sending written or electronic communication, you must encourage the borrower to establish live contact with you. This means you must ask them to give you a call or maybe come into the branch in person so you can have that live contact. Now on this next slide, I've included some loss mitigation options. Since under the early intervention rules, this is the time servicers should begin informing the borrower of these options, of course, as appropriate. So some of these options to help mitigate foreclosure could be a loan modification, loan that goes into forbearance, maybe a short sale on the property, or a deed in lieu of foreclosure. The next slide covers some aspects of the continuity of contact requirements for a large servicer. And I really feel this is kind of an extension of the early intervention rules. It really ties back to some of the requirements under the early intervention rules. But continuity of contact requires policies and procedures to ensure that personnel are assigned to a delinquent borrower. Now, personnel can be a whole department or team. It doesn't have to be just one person. Personnel must be assigned by the time that written notice that was required under early intervention is sent, but not later than the 45th day of delinquency. And assigned personnel has required functions. Again, we don't have time to cover all of those required functions today. However, you can find that information at section 102.440. The loss mitigation procedures within the rule are quite lengthy, and specific scenarios and timing requirements go with different certain scenarios and instances. On this next slide, we're going to go ahead and just summarize some of these requirements. There are certain requirements when we receive a completed application. We must evaluate timely appeals submitted by eligible borrowers. We need to provide the borrower with a notice that informs them of any specific missing or additional information that we might need to evaluate a loss mitigation application. And if we change the slide, we can go on and talk about a few more. Servicers should refrain from beginning or completing the foreclosure process in certain circumstances when a borrower is being evaluated for loss mitigation options. And the requirements upon receipt of a loss mitigation application really vary depending on a few things, whether the application is facially complete, whether it's not complete, whether a foreclosure sale is scheduled, and the number of days before the sale. Now, all of these requirements are detailed in section 102.441. But the most common errors that we see with all of these large servicer requirements, and I am sure you've heard this a million times if you are any part of compliance, is documentation, documentation, and more documentation. Either the steps of early intervention, continuity of contact, and loss mitigation procedures are not clearly documented to substantiate and demonstrate what steps the servicer has taken or when the servicer has taken these steps to really document and ensure that the timing and each step was appropriately completed. And that brings us to our final large servicer requirement for today. Again, this is one that maybe will be a surprise to some. The forced placement of hazard insurance is prohibited if the insurance is escrowed and the servicer can continue the existing coverage. Again, this is for when you qualify under a large servicer. So the most common error here is not retaining documentation which demonstrates the attempt made in continuing their existing insurance policy when you actually do forced place being a large servicer. Okay, on the next slide, I thought since we were talking about forced place hazard insurance, I felt that was an appropriate segue into the differences between forced place hazard procedures and forced place flood procedures on the next few slides. Now, under RESPA, the rule puts limits on charging the borrower for forced placed hazard insurance. These limits include having a reasonable basis to even believe that the borrower has failed to maintain required hazard insurance. Then the servicer must send 2 notices to the borrower for a new forced placed policy and not have received in response evidence that the borrower has actually purchased and have in place required insurance. And then also charges for forced placement that's imposed on the borrower must be bona fide and reasonable. RESPA loves that caveat, bona fide and reasonable. The next slide here demonstrates the timing requirements for notices and the imposition of forced placed premium on the borrower for a new forced placed hazard insurance policy. The first notice or initial notice must be provided at least 45 days prior to assessing the forced placed premium to the borrower. The second notice, or referred to as the reminder notice, must be provided to at least 30 days after the initial notice was provided and no later than 15 days prior to assessing the premium to the borrower. This reminder notice is not required for a renewal of a forced place hazard insurance policy. Now note that these notifications have content and format requirements under the rule, which are detailed in section 102.437. And then finally, the premium may not be assessed to the borrower until after 45 days after the initial notice provided and 15 days after the provision of the reminder notice. Now, the renewal of forced place hazard insurance policy has a few differences. First, we must still notify the borrower of a renewal of a forced place hazard insurance policy. Now, you'll see that this is a difference from the renewal of forced place flood insurance policy we'll talk about in a few moments. Only one notice is required for the renewal of a forced place hazard insurance policy, and that notice is referred to as the renewal notice. The renewal notice has certain content and format requirements similar to the notices provided for a new forced place hazard policy. Timing requirements are the same as the initial notification required for a new forced place hazard insurance policy, and that the servicer may not charge the borrower until after the 45th day following the renewal notice provision, and no response to the notice has been received from the borrower that would evidence that they've already purchased insurance. So let's move on and compare forced place hazard insurance procedures to the forced place flood insurance procedures. While RESPA does not put requirements on the amount of coverage for hazard insurance, the flood rule does include minimum required flood insurance coverage. That required coverage is the lesser of the loan's outstanding principal balance, the property's insurable value, or the maximum coverage available under the National Flood Insurance Program. Now we're going to start with the notification requirements for a new forced place flood insurance policy. The notification should be provided at the time the institution determines that there is no coverage or insufficient coverage, and there's only one notice required under the flood rule, while two for forced place hazard. Like the forced place hazard insurance requirements, the notice for forced place flood insurance must be provided at least 45 days prior to assessing the premium to the borrower. Now, something to keep in mind here is the new FAQs published May of 2022 indicated that the notice should not be provided prior to the expiration of the policy, and yet any delay in providing that notice after the expiration of the policy will need to be explained. So it is imperative here to track flood insurance coverage so that the forced placement procedures can begin in a timely manner after expiration or determination of a lack of or insufficient coverage. And of course, don't let them delay too late, otherwise you're going to have to explain that delay. Now the procedures for a renewal of forced place flood insurance policy are quite different from that of a renewed forced place hazard insurance policy. While with hazard insurance, there's only one renewal notice that must be provided to the borrower, no notification is required for the renewal of a forced placed flood insurance policy. In fact, the May 2022 FAQs state that while not required, a servicer may send one as a courtesy, but they don't have to. And of course, since there's no notification required for a renewal of a forced place flood insurance property, the premium can be assessed to the borrower on the date of the renewal. Moving right along, we'll take a look at some errors to avoid with regard to escrow accounts. We're going to start with escrow account cancellation, as we've seen many errors regarding this topic. We have borrower requested cancellation procedures, and there's non-borrower requested cancellation procedures. For borrower requested cancellation procedures, the most important aspect to remember is timing. The borrower must receive the cancellation notice at least 3 business days prior to the closure of the account. But the mailbox rule applies here, so that the notice would be considered received 3 business days after placing the notice in the mail. That's our most frequent error we see. They don't remember that it's not considered received until 3 business days after placing in the mail. And business days for this portion of the rule are there on the slide, which are basically your mailing days. Now, with non-borrower requested cancellation procedures, again, very important, the aspect to remember is timing. The borrower must receive the cancellation notice, this time at least 30 business days prior to the closure of the account. Since the borrower is not requesting it, and it's going to be up to the institution is the reason why they're closing it, again, that notice needs to be received 30 business days prior to the closure of the escrow account. The mailbox rule still applies here, and the business days are the same, which are basically the mail delivery days. As far as the cancellation notice itself, the notice has some format and content requirements. You can find those at 102620E. But some errors that we see that you need to avoid in the cancellation notice itself would be not including a table that's labeled cost to you. Sometimes we just see a title that says cost to you, but the regulation is very specific and wants this section to be in a tabular format. Also, we see missing a statement whether there is an option of even keeping the escrow account open. And a required statement is typically missing of the cutoff date by which the borrower can request that the account remain open. Now, the last escrow item I wanted to bring to light involves how a servicer handles an escrow account shortage or deficiency greater than or equal to 1 month escrow payment. Since the rule is very specific on how these can be handled, the servicer cannot give the borrower any options outside of what is permitted in the rule. Those permitted options are to simply allow the shortage or deficiency to exist. Shortages can be required to be repaid in equal monthly payments over at least a 12-month period, and deficiencies can be required to be repaid in 2 or more equal monthly payments. What we cannot do is require the borrower to repay or even give the option to the borrower to repay in one lump sum payment. So be sure to check your escrow account disclosure statements. Make sure they do not give that option to make a lump sum payment for shortages and deficiencies greater than or equal to 1 month escrow payment. Now, moving right along to ARM rate and payment change notices. This slide gives you some information regarding the general notice that will be provided for any change in rate and payment during the life of the loan. It is not required for loans with a term of 1 year or less. But we got to remember to watch the time from our note date to our maturity date. If that's more than 12 months, this notice is triggered, as well as many other Reg Z requirements. We see this happen most frequently on a refinance, where the maturity date is kind of pushed back a few days because of that rescission period, and the duration on the note from the note date to the maturity date is longer than 12 months. This notice also has content and format requirements. The slide references where you can find that information. This notice is generally provided at least 60 days, but no more than 120 days before the first payment is due at the adjusted level. And for ARMs that are originated prior to January 10th, 2015, or ARMs with a rate adjustment every 60 days or more frequently, the notice should be provided at least 25 days, but no more than 120 days before the first payment is due at the new rate. Now, the initial rate adjustment notice is the notice that's provided only once, when the loan's rate is set to adjust for the very first time. Again, it's not required for a loan with a term of 1 year or less, so watch those note dates to maturity dates. This notice also involves content and format requirements. Again, the slide notes where that information can be found. And this notice is provided at least 210 days, but no more than 240 days before the first payment at the adjusted level is due. Now we're almost finished with loan servicing, with one more item to cover after payment processing procedures. Reg Z puts some requirements on when payments must be applied to certain loans. The loans that have these special requirements are all open-end loans. So your HELOCs, your overdraft protection accounts, revolving lines of credit, and credit cards. Also, closed-end consumer credit transactions secured by a principal dwelling, regardless of lien status. And what are those requirements? Well, if a servicer does not specify in writing reasonable requirements for making payments, payments must be credited as of the date of receipt, unless a delay does not result in additional finance charges or other charges, such as late payment fees, and the delay does not result in reporting negatively on a consumer report. If the servicer does specify requirements in writing and a payment is made that does not conform to those requirements, then that non-conforming payment must be credited within 5 days of receipt. That brings us to our final loan servicing topic, error resolution requests. Loan servicing error resolution requests typically fall under two categories. We have our billing error disputes under Reg Z, and we have our qualified written requests under RESPA. Now, there are many timing, notification, and investigation requirements under both of these rules. But today, I really wanted to hit home how important it is to have specific processes and procedures in place to handle any type of error resolution request as defined under these rules. Just with commercial loan applications that are not originated, many times during reviews, we request billing error disputes and qualified written requests, and our clients will have none. Which that could be likely, as most people will just call into an institution and discuss an issue. They don't necessarily send a letter. But with that said, if someone emails their lender about an error on their bill or servicing on their mortgage loan, that lender should have knowledge of the procedures on how to handle such requests appropriately. So some of those procedures could be, just an idea, forwarding to a central department or personnel to handle all such requests. So they're trained appropriately, they know exactly the timing requirements, and it's all handled in one area. So that way you can ensure the request, the investigation, and responses are appropriately being tracked and monitored. Also, we want to document the full process from the receipt of the error from the borrower all the way through the notification of the result of the investigation to the borrower. And a good idea would be to train all staff and make them aware of all the error resolution procedures that we're going to implement and put in place. So hopefully everyone's still awake out there, because it's time for me to pass the mic back to Brad to wrap things up. Back to you, Brad.
No, thanks, Sadie. So lots of good information there. So if we head to the next slide. See if we can advance the slide, please. All right, so here, the link at the top of this page is to an April 2024 edition of the CFPB Supervisory Highlights that was dedicated to mortgage servicing. So Sadie just got through telling you about the issues we see. The linked publication is the CFPB's way of telling you what they see. And in this, they didn't waste any time. They opened the third paragraph of the edition by stating the CFPB continues to prioritize scrutiny of exploitative illegal fees charged by banks and financial companies, commonly referred to as junk fees. So they go on to name improper property inspection fees and improper late fees as examples of these junk fees. For those of you that service Fannie Mae loans, the CFPB identified instances when property inspection fees were charged to borrowers when those inspections were prohibited by Fannie Mae guidelines, and they considered this to be an unfair practice, so brought UDAP into the picture. If you service these loans, be sure that your staff is aware of when these fees can and cannot be charged. Regarding late fee overcharges, two issues were surfaced. One was charging fees above and beyond the amount provided for in the note, obviously a no-no, and the other was charging late fees after the borrower had entered a loss mitigation agreement that should have prevented the assessment of these fees. Again, these were considered unfair acts or practices. Periodic statement fee descriptions dealt with Reg Z's rules, so this is for large servicers. requiring a brief description of the transaction. What the CFPB found was that the general term service fee was being used for multiple types of fees with nothing to distinguish the reason for the service fee. Sadie talked about a few escrow related issues. The CFPB added untimely disbursement from escrow accounts to the list. We see that occasionally, but not often. An example cited by the CFPB was when the initial payment from the escrow account did not reach the payee, then subsequent attempts to make the disbursement were not timely and resulted in the borrower paying late fees. We've mentioned a couple of practices that were considered unfair, and you can see towards the bottom of the slide a couple more that were considered deceptive. And then Sadie already talked about live contact or early intervention. Since we've pretty much hit our hour limit, I'll let those of you who live in the servicing world read the supervisory highlights to get more detail. And always feel free to be in touch with us to talk about any questions, anything you want to bounce off of us. So we'll go ahead and have a slide here. It just has a couple links you might find helpful. And then we will end with a couple more polls real quick. So the next poll is we're simply asking you to help us choose the topic of a future webinar. We want to be sure to cover the items that are of most interest to you. So just type a brief 1 or 2 word topic that you'd like to see. I'll bet we see some 1071, some CRAs, fair lendings. But if there's something else you're interested in, such as BSA, EFT error resolutions, credit quality, you name it, please go ahead and type that in now. And keep in mind that a Starbucks gift card is up for grabs for those who answer. So it looks like 1071 is the most popular one so far, but there's a few others. Some new ones, appraisal bias and AVMs, credit analysis. Good. All right, so we'll close that down in 5, 4, 3, 2, 1, and we'll close that poll. So thank you very much. And then our final poll is we'd just like to know how you heard about the webinar. Was it from an email we sent you, a blog post, an ad in the Missouri Banker, a postcard one of us handed you, a website announcement, again, whatever it was, please let us know. And did I mention that a Starbucks gift card's up for grabs for those who participate? As much as I've mentioned them, we should probably get Starbucks to sponsor the next webinar, don't you think? So again, we will give you 5, 4, 3, 2, and 1, and we'll close that poll. So it's like email is probably the most efficient and effective way to get things out to everyone. All right, so we have 5 gift card winners to announce. For the poll on counter offers, the winner is Carmen Atalaya. I hope I got that right, from Kearney Bank. Thank you very much. For the poll on commercial loan apps, the winner is Janine Cooley from Lake City Bank. Thank you very much, Janine. For the poll on commercial loan apps, the winner is Audrey Russell from the National Bank of Indianapolis. So very good. My daughter just enrolled in the University of Southern Indiana. So great to have someone from Indiana on the line. And then real quick, we'll get the final 2 winners. And if we don't get them right away, we'll just send an email out to you informing you of that. So I want to thank everyone who participated. And for those of you who won Starbucks cards, please send me an email just to be sure we have good contact information for you. And you can find, let's go to the next slide. You can find my email address right there on the second line, bstumpy@anderscpa.com. So we have poll four winner of the next topic, Angela Wilcoxon from Southern Bank. Thank you very much, Angela, for attending today and participating in the polls. And some of you might prefer to let Sadie know. She's a little nicer, a little more responsive. And you can find her contact information on this slide. And also, please don't hesitate to be in touch with either of us should you have any questions on adverse action notices, loan servicing, anything else compliance related. And then the final winner we have for how you heard about us is Kathleen Motley from First Bank. So thank you, Kathleen, for participating as well. And with that, it pretty much brings this webinar to an end. I'd like to thank you for spending part of your day with us. And we hope to see you back again for our third quarter webinar. Be on the lookout for emails and blogs announcing the date and topic of that one. In the meantime, happy 4th of July. Thanks, everyone.